Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. It's Wednesday, it's April 12th. Before I get into this video, I want to make sure you like our YouTube Wealth Press channel. It's the Wealth Press YouTube channel. Subscribe to it, like it, post comments, feedback, and subscribe to our Telegram channel. The link is below the video in the YouTube channel. I give free trades there sometimes. How exciting is that? And I post pictures of my animals. It's all good. Folks, today is Wednesday. It's a big day. It's hump day. That's not why I'm so excited, because today we have a big announcement. This announcement is going to cement the fact that the Fed is in fact going to raise rates a quarter of a basis points. Now, in the last month, we've gone from a 75% chance of a 0.25 rate hike to zero, I think 3 or 4 times, back and forth. Yesterday, we had 66% that the Fed is going to raise rates. Today, it's 75 because we're getting closer to the report, and this means the Fed is more likely to take action than not. But today's report is going to cement everything for us, and I'll get into all of the nukes and crannies for you in the next few minutes. Now, Nasdaq is flat. Dow is up about 83 points. Obviously, if the Fed raises rates or increases the odds in the sentiment of raising rates, that'll impact technology more, which is one of the reasons technology has not been as strong lately. And yes, somebody with the initials RS has warned you that was going to happen across the board over the last several weeks. Now, before we get into the nitty-gritty, let's talk about the big report that's on the table today. And this report is going to come out actually right around the time you get this video. It's the CPI report. I'm going to talk about it twice, plus we have a bunch of Feds talking, and what they're singing is not a pretty song. But this is the crux of today's report. Now, they're going to talk and talk. The key question is the core CPI going to come in below 5.5 or above 5.5? If it comes in at 5.5 or above, the odds of Fed raising rates is probably going to go to 100% that they're going to raise rates. If it's 5.3, 5.2, then the odds will back away a little bit. But I genuinely believe the odds will be on the upper end of the range, and I think the Fed is going to have to take action. I don't think there's going to be any ins, ands, or buts about that. Now, the bond market, as I will show you right now, if you look at the bond market, you will see that the bonds have been very choppy the last few days, but on a downward trajectory. I think if the Fed is going to take action, if the CPI is going to be worse today, the bond market's going to come lower, because that means interest rates are going to go higher and the sentiment towards higher rates will continue, which is one of the reasons we've seen a sell-off. If the number is surprisingly good, well, then the bond market may rally, and the stock market may rally, especially tech on that news, because that means that there's a higher odds that they're not going to increase. So the crux of today comes down to this number right here. And it's really important because this is the last huge report before the Fed takes action in about 20 days from now. They're slated to speak on the 3rd. Now, with that said, let's talk about the analysis, and I'll get into the charts after this, and I'll kind of regurgitate what I just said in a different way to make you guys, to explain it to you from a perspective of the financial media. Market participants are looking ahead to crucial U.S. inflation data today, which is coming out in about an hour and 3 minutes from the time I'm doing this video. It's 7:27 right now. Now, the Dow notched a 7-week high, but benchmark S&P closed lower. Why? Because the tech-heavy Nasdaq closed lower for the 5th time in the last 6 sessions, as a rise in U.S. Treasury yield weighted on tech and tech-adjusted mega-cap stocks. It's that simple. You just can't get away from that. And you will see a lot more of that today before they open, if in fact the market, if the CPI is not as strong. Now, look at what the Fed is saying. They're not. Everyone except Squirrely is giving us pause. But look at this. They're being very clear. Fed President Austin Goolsbee said on Tuesday that the Federal Reserve should exercise prudence and patience in raising rates after last month's banking turmoil. Well, that doesn't mean they have to stop, right? At the moment like this of financial stress, the right monetary approach calls for prudence and patience for assessing the potential impact of financial stress on the real economy. Have you heard of any other banks going under in the last month besides the 2 that were mismanaged? No. Fed President Patrick Harker said he believes the U.S. Central Bank needs to get interest rates above 5% before pausing to bring inflation back to its 2% target. At the same time, Kashkari, he's a straight shooter, warned the Fed's interest rate increases and tightening of the credit conditions after 2 bank failures last month could lead to a recession. So it looks like they're backing off a little bit. The International Monetary Fund on Tuesday trimmed its forecast for global real GDP growth to 2.8% from a January forecast of 2.9 and cut its 2024 global GDP to 3% from 3.1. And earnings estimates have been going down too. We'll get into that a little later in the week. Now, here's the crux of everything that's coming out today. All eyes are focused on consumer inflation data. They're talking about the real numbers, which nobody cares about. I'll get into the core numbers in a second. But yesterday, the odds were 66% we were going to raise quarter of a basis points. Now they're 71%. So what the Fed is saying is not really helping, all right? I'm just being honest with you. The CPI is going to decide this. And I haven't seen any other bank failures. Have you heard anything negative on bank stocks besides those two stocks? I haven't. It's been a while now, but they keep bringing it up. There's a reason they're bringing it up. They're trying to use that as a chip, as a bargaining chip to not raise rates. But I don't think Squirrely's going to do that. And as he said, and as Yellen said, this banking fiasco is not contagious. It's limited to these banks. So why are these Feds talking about mixing global economy with two bank failures? You see what they're doing? They're manipulating you guys, which is not cool. So in addition, so here's the nukes of the cranny, core CPI. This is all of what today's about right here, and not monthly. It's right here. They're looking at a year over year at 5.5%, where it's last year, this time was 5.6. So they're looking to see if this number is going to be 5.6 or 5.5. If it's 5.6, maybe even 5.5, they're going to raise rates. They're going to raise rates. If it goes to like 5.1, they may say, what we're doing is working. Let's see how it goes. The system is stressed because of these bank stocks, which it's not. And Yellen confirmed that, but they're going to sing their song. In addition, market participants will be watching for minutes from the March meeting to get some fresh insight from the monetary policy. Europe, everybody's waiting for today's Federal Reserve data. China closed slightly higher, but investor sentiment took a hit after softer than expected inflation data released Tuesday pointed in a weaker than expected recovery. I was surprised. They were really boasting how they're going to be recovering and they're getting out of COVID after 3 years. And now the reality is it's not happening that fast. The Nikkei, the Japanese market, rallied again because of Warren Buffett's intention to increase his investment in this country, which I'm looking for, and I'm curious to see what he's going to do. But honestly, folks, all eyes are on the TLT or the 2-year, which SHM, which you could see right here. This is like a short-term bond that covers the market, and you can see it's been kind of rising. So I'm honestly thinking that the Fed is going to take action, and I don't think the number is going to be that great, and I think we're going to come closer to 5.6, 5.5 than 5.0. But again, it'll be very interesting to see where that number lies and how it comes up. Now, notice small caps have started weakening out. Look at the small caps compared to the SPY right now. The SPY looks a lot stronger. It's in the upper end of the range, and IWM, which is the Russell 2000, it's at the lower end of the range. Now, remember what I always tell you. When recessions are ending and it's the end of this, small caps, tech stocks, those type of stocks tend to rally more. We're totally not seeing that. And as I mentioned, the QQQ has been lagging behind the broad market. Let's see this right here. It'll be interesting to see if it falls down or comes back up. But this number, this where we're at right now, can go either way. And based on where I'm seeing and what I'm seeing right now, it looks like there's a higher chance of it cooling off than going up, especially with rates being where they're at right now. Now, let's look at sectors, and so we could see all the different sectors, so I could show you what impact it has the most on today's rates. Now, communication services is technology, and so is technology, and they've been following each other. So if the number's negative, these two will be negatively affected. They've been negatively affected now for a few days. Not communication services as much as technology, because this has chips, and chips have been petering out the last couple of weeks. Basic materials are not going to be impacted nearly as much because we're not talking about a recession. We're talking about inflation or not. Energy is actually coming back up, and energy doesn't do so bad in an inflationary environment, and I think we're going to be in an inflationary environment for quite some time. Healthcare looks like it's topping out here, and also my momentum studies, which I'll show you right now, also show that healthcare looks like it's really, really topping out. Look at this graph. I mean, you got to see this. Let's see here. Look at that. So healthcare looks a little overbought as well right now. Let's continue. And healthcare is not that important when it comes to interest rate fluctuations. But if the numbers are really good, you could see folks taking money out of healthcare and putting them into technology, but I don't think that's going to happen. Consumer staples is rocking and rolling, and again, just like energy in an inflationary environment, which is where we're at and we're going to be for quite some time, consumer staples are a good bet. I like energy, I like material, I like the consumer staples, I like the industrial stocks right now. Consumer discretionary, I do not like. And remember, earnings are going to be coming out. And I'm only seeing negative revisions. I'm just not seeing such a great thing from these companies. Now, utilities and bonds have a direct correlation to each other because remember, when real estate, utilities, when people buy utilities typically for yield, for interest yield, for dividend yield, and it's always between bonds and utilities. So bonds go up, interest rates go down, people put their money in utilities. So there's a strong correlation between bonds and utilities. So if bonds go down, we could see utilities take a dump too. Real estate is also really impacted by interest rates. So if interest rates go lower, right? If they go lower, real estate would probably go higher. But if interest rates go higher, it means if bonds go lower, real estate could potentially go lower as well. Because again, a lot of these indexes or sectors are related to the market. Financials, I think, are overdone. And seasonality actually looks pretty good for them at the end of the week. They start earnings on Friday. And so far, I'm actually liking financials because I think this is way overdone. This 36 to 31, I think it brought them way to the other side. So the sectors that I like are basic materials. I like energy. I like consumer staples. I like industrial. I would be cautious with utilities right now. I would be cautious with real estate because it's very sensitive to these type of moves. And I like financials. So a few sectors I like, a few sectors I don't like. I like consumer staples, real estate question mark, utilities question mark, financial I really do like, which is surprising. Most people don't like them right now. Consumer discretionary, you got to be really careful. Technology, you got to be really careful. And communications, you got to be really careful. Now, today's hump day, it's Wednesday. And what do I usually do on Wednesday? I give you my top stock and I give you my crappy stocks. Well, my top stock for right now, it's FedEx. That's right. Boring FedEx. Look at this stock. It's been going crazy. Maybe wait for a little pullback. Maybe wait for the 5-day RSI. Let me just go to the RSI here. I would wait for the 5-day RSI to get a little over. It's a little overbought right now. I would wait for it to go here to the downside. Just a hair. Just a little bit. Maybe even even level. Not right now. Just wait a little more and then pounce on this. Now, to the downside, oh boy. Digital Realty Trust. Where do you think this is going to go? I mean, look at this. With the market vulnerable right now, with people moving out of New York City, where do you think with technology having a big headache, do you think this is going to rally all of a sudden and change the world? Come on. Let's be real here. Maybe another day up and this thing comes down. Another stock, Digital Realty Trust, they rent space to digital companies that need server space. Right now, companies need less server space because we're in an inflationary environment. We're not in a COVID environment. So in the last several months, this thing has not been able to rally. And Office Depot. 1, 2, 3, I think this thing is ready to come down. I'm just not liking it or feeling it. And people are working from home a lot more right now. Home Depot's not getting a lot of love. People are also relying on credit, so they're spending less money at Office Depot right now. So Digital Realty Trust is a bear. ODP, Office Depot, is a bear. FedEx is a bull. Now, keep your eye on the report. It's coming out in 52 minutes to be, I think 52 minutes. Yeah, 52 minutes to be exact. Now, folks, before I let you go, I've dedicated my life, literally, I've dedicated my life to finding the market's strongest stocks. Like FedEx, look at this baby, it's beautiful. But right now, there are opportunities in the weakest stocks that are just too big to ignore, like Digital Realty Trust, Office Depot. But these are just some stocks. Imagine some real live fresh meat signals, red meat signals. And thanks to a single pattern, a really high probability pattern that preceded some of the market's biggest drops, man, we can use the worst stocks to find some of the best potential trading opportunities. Now, I held a special training session yesterday, and I wanted to share the strategy with you, and it's still not too late to check it out. You don't want to miss this out. You're going to absolutely love it. Follow the link below. Check it out now. And if you're in the Wealth Press YouTube channel, there's a link below the video. If you're on our website, there's a link right below the video too. But if you're on our website, like the channel, I'm in the YouTube Wealth Press channel. I post those videos there as soon as I'm done with them, so you can probably even watch them before getting them from the website about an hour earlier. Follow the link below. Telegram channel link is there. This way we could stay in touch, and you can always send me an email, support@marketgeeks.com. Post comments and feedback. I will respond personally. Bye. Have a great hump day, and I hope the Fed doesn't hurt us too bad. Keep your eye on this report. It's going to be hot. Follow the link below. Check out the class that I presented. It's going to blow your mind. Yes, you can make money to the long side and to the short side. Bye. Have a great day. See you soon.